Now, there's been a lot of talk about a budget black hole, 20–30 billion pounds. But arguably the real hole in UK finances is much greater. Unfunded liabilities of pensions, crumbling buildings, infrastructure backlogs, PFI commitments, a housing crisis, social care going through the roof, and all this occurring against a backdrop of lower economic growth, rising inactivity. Now, in recent weeks, there was shock when prisoners were mistakenly released early. But although figures this year are a record, it is not a new phenomenon. Since 2008, the Justice Department has been one of the biggest targets of austerity. By 2020, justice spending was 24% lower than 2007, and adjusted for the higher population, nearly a third lower. Cutbacks have left a prison system with overcrowding, bad morale, and crumbling buildings. A parliamentary report suggested 75% of prisons were inadequate or showing no improvement, with education cuts and reoffending rates rising. At a minimum, prisons will need an extra 1.8 billion to deal with the current crisis, and even more to deal with the backlog in criminal courts. Now, if it was just a prison service in crisis, it would be quite fixable. But cracks are showing in almost every area. One of the hardest hit areas has been local councils. Local councils again suffered heavily from the austerity era, with funding cut significantly. But at the same time as funding cuts, they face three huge pressures for more spending. They have a legal requirement to provide social care, temporary accommodation for the homeless, and education for special needs. The social care bill has skyrocketed as the population ages, but councils have limited tax-raising power. They've been asked to provide a service without the means. It's taking over budget and bankrupting local councils. Secondly, the cost of living crisis, especially in housing, has seen a rise in homelessness, defined as living in temporary accommodation, the UK one of the worst in the world. As a result, council spending on temporary accommodation has increased. And the third burden has been the rise in special needs education. The number of pupils with SEND or EHCPs has increased at least 20%, and a council have a legal requirement to send to a school of choice, even if it involves a taxi bill running into millions of pounds. But this is a problem set to get worse, with a recent survey of local councils suggesting the expected special needs deficit is forecast to soar from 4 billion to 17.8 billion by 2029. And the rise in mental health problems amongst the young is a ticking time bomb in terms of finance. Since 2016, the number of children receiving child disability allowance has increased by 100%. And one of the stats that raises concerns is the expected rise in health-related benefits, both PIP payments and incapacity benefits. 98 billion definitely is a big bill, but this is still dwarfed by the expected rise in pension spending. The basic maths is that the ratio of old people to working age people is going to rise from 25 to 45 within a few decades. But at the same time, we have a system where state pensions are likely to rise faster than wages, making it very hard to afford without ongoing tax rises. And it is worth bearing in mind that despite the fact that pension spending is going to rise as a share of GDP, the UK state pension is actually relatively low compared to other European countries. The UK still relies heavily on private pensions to top up to meet a satisfactory retirement income. And the problem is that when you rely on private sector pensions to meet half of pension income, some will slip through the cracks. For example, for self-employed like myself who have a very low rates of private pensions. And there's another complication. In the past, retired people generally had low housing costs. Either they paid off their mortgage or lived in subsidised social housing. But the rise in rents, combined with a fall in home ownership, means we have a new generation of retirees having to pay market rents whilst only getting a pension income. The problem is not so much of intergenerational inequality, but inequality between those who own a house and those who don't. The share of British people paying more than 40% on housing is one of the highest in the world, and this is a real hidden cost in terms of cost of living, and it kind of puts pressure on government benefits to stave off the worst of poverty. But the problem is that with so much short-term pressures, the state doesn't feel it has the capacity to invest in long-term solutions, like, say, building houses. In the 1970s, the government did build housing, but now we spend that money on housing benefits. We shouldn't underestimate the impact of an ageing population, because not only will pensions go up, but also so will healthcare spending as a share of GDP. Now, if this sounds alarmist, bear in mind that forecasts of UK fertility rates have generally been wrong and actually over-optimistic. Now, I guess that one silver lining of lower birth rates, at least from a financial perspective, is that we will be able to close schools and cut education funding because there will be less children, which is probably a good job, because as pension benefits take a bigger share of GDP, other budgets like education will be squeezed. Now, at this point, you might be thinking, that's enough of the bad news. Can't you give me something a bit more positive? Well, I don't know if this is good news or bad news, but austerity did actually shrink working age benefits as a share of GDP. For all the panic of rising health-related benefits, working age benefits have actually stayed fairly constant as a share of GDP. In fact, some argue that the reduced value of universal credit actually created an incentive to try and get on health-related benefits. But of course, the downside is that this has come at a cost of rising child poverty, which does store up problems for the long term. But in terms of budget black holes, one black hole we haven't mentioned yet is public sector pensions. Traditionally, public sector jobs often traded relatively lower salaries for more generous pensions. The Daily Telegraph cite a former Bank of England economist who claims the UK will have 5.8 trillion in total pension promises by the end of 2025 to 26. Now, this figure is kind of misleading because it includes the future effect of inflation and wage rises long into the future. The Treasury state the discounted present value of pension liabilities are closer to 1.3 trillion. And actually, they say that changes recently introduced have actually reduced the net cost of public sector pensions to the taxpayer. Nevertheless, the scale of unfunded pension liabilities are a problem and will require higher contributions from the employer, which of course is the taxpayer. Now, the NHS is one area where government spending has actually increased significantly, one area that didn't hit by austerity yet. Partly due to COVID, it has failed to prevent waiting lists reaching over 7 million, only very slowly coming down. And in addition, there's been a growing backlog in maintenance, with estimated costs rising from 6 billion to 13 billion in a decade. And crumbling infrastructure has often seen hospital treatments delayed. But it's not just the NHS. The National Audit Office estimated that at the end of 2024, the UK maintenance backlog was £49 billion, or £730 per person. And during austerity, it was often capital investment that was cut first, because the effects didn't show up in the short term. And not only that, to save money, in the short term, the government used private finance initiatives to raise capital. But even though they've been stopped because they were deemed to be very bad value for taxpayers, of 700 PFI contracts, which gave a capital value of 57 billion, 160 billion is still to be paid by the taxpayer for their use and maintenance. In a similar vein, 2 decades of privatisation raised £70 billion in one-off payments, but it left key public utilities in the hands of the private sector equity, which was underinvested, paid dividends, and left payers and taxpayers with the cost of higher bills to fix a creaking industry. And nowhere is this more evident than in water. Privatised with zero debt, the private firms loaded up their debt, paid themselves dividends, but now the companies need bailing out by taxpayers and bill payers. Another cost not on the government's balance sheet is contingent liabilities. The OBR report this is £250 billion, or 8.5% of GDP. By far the largest is a £115 billion liabilities relating to the cost of decommissioning nuclear sites. The next biggest liability is clinical negligence for lawsuits about healthcare, and these liabilities are expected to last over 30 years. Another cost we're facing is the energy transition as we move from fossil fuels to renewable energy. And even if wholesale prices of electricity fall, the cost of all the grid investment and network costs and subsidies will lead to higher energy bills by 2030. And this is a problem given that high electric costs are a big factor in causing the decline in UK industry and leading to lower growth. Overall, the energy transition will be a net cost to the economy until 2040. But it is worth bearing in mind, on the other side, the impact of climate change will also likely to be reduced GDP with higher insurance premiums and increased volatility. And it's not only the weather which is potentially more volatile. Geopolitical pressures are leading to demand for a big increase in defence spending. Basically, in the post-war period, we were able to increase healthcare spending by reducing defence spending. But now we want to increase both at the same time. So how will this extra spending be financed? Well, we will probably see public debt continue to rise. And it is worth bearing in mind the government's fiscal rules assume debt falls within 5 years, and this is what the OBR duly forecast. But in recent years, of course, the actual outcome has always been that debt continued to rise higher than forecast. So it's not unreasonable to assume that debt will keep rising. Now, this OBR forecasts assumes no change in government policy, so it shouldn't be treated as gospel. Definitely could change this trajectory. But actually, I would say that debt is likely to rise faster in the short term than these OBR forecasts suggest. Now, the problem is that the UK also faces another kind of hidden cost that gives no benefit to the taxpayer at all, and this is rising debt interest payments. They've already shot up in the past few years, actually causing much of a fiscal black hole. But there are reasons to fear that the UK's borrowing costs may continue to remain elevated and probably go up even more. Firstly, global debt is rising, but the UK is increasingly dependent on overseas buyers, and they will demand higher yields to compensate. Secondly, changes in UK pension funds from defined benefits to defined contributions means there'll be less demand from UK pension funds. Basically, the gilt market is going to lose one of its key buyers. Less demand means lower prices and higher yields. And the OBR predict an eventual increase in annual debt interest costs of around £22 billion just from this change in the type of pensions that we go for. So in summary, all the big areas of government spending, health, pensions, benefits, defence and interest payments are all set to rise as a share of GDP. But this has to come from somewhere. You can't keep having bigger pieces of cake without reducing the size of other areas of spending. So we'll have to cut spending or increase taxes even more than they've already gone up. Now, some would like to feel that a wealth tax could come and ride to the rescue, but even fairly generous models suggest at best they may rise 10 to 20 billion a year, which, as you can see from the sums involved, is really a drop in the ocean. Now, all of this wouldn't be a problem if we had strong economic growth, but since 2007, that hasn't happened. Average growth rates are falling, which means less tax revenue. Tax has gone up as a share of GDP, but the shortfall remains, which makes it necessary to increase taxes even more. But this is difficult when so many types of the big taxes like VAT, income tax, national insurance are seen as politically difficult to increase. So what is going to happen? Is the UK going to go bankrupt? I don't think it will, but what we will have is a long but difficult period of kind of muddling through. At some point, services will get so stretched, something has to give. And it's already happening already with a shortage of NHS dentists, pushing people into the private sector. Now, if that's all too much bad news for one video, let's have a look at what Britain is actually good at, because focusing on what your strengths are is actually the best way to improve the overall economy and try to deal with some of these long-term pressures. Well, thanks for watching. The good news is we have a budget coming up next week, so I'm sure there'll be lots of interesting things to be looking into. Do subscribe and see you soon.